The cyclically adjusted PE ratio is sort of a guide that people use to look at whether the market is overvalued, undervalued, right now very expensive. You say it's a useful signal for predicting long-term market returns. What does the data say right now?
Well, firstly, it's important to note that any valuation measure and the Shiller PE ratio or the CAPE ratio is no exception to this rule. Valuation ratios are terrible for picking market tops and bottoms. They're terrible for market timing. However, they're wonderful for predicting long-term rates of return. And what we find today is that the Shiller PE ratio, price relative to 10-year smoothed averaged earnings, is at 32 to 33 times earnings. What that means is that every $100 you invest buys you about $3 of average earnings over the last 10 years. That's a huge valuation multiple. And what that tells us historically is that we should expect roughly 0 to 2% real return over and above inflation over the next 10 years. That's all.
So just to be clear, the market's not going to crash per se just because the market's expensive by this measure, but over the long term, you wouldn't expect to do phenomenally well here. Now, the critics of this approach, they have a lot of flaws, and so one of them, they point out a lot of theoretical flaws. One of the things they say is, well, yes, if you take the last 10 years of earnings, that includes the financial crisis when we all know earnings were in the toilet and many industries actually produced losses. So why would you want to go back that far when that is a maybe twice or once in a century event that's just distorting the whole thing? What do you say about that?
Firstly, I find it really amusing. Critics come out of the woodwork whenever the Shiller PE ratio suggests caution. They're never there when the Shiller PE ratio says to buy. Secondly, the arguments that they raise are always a two-edged sword. Let's ignore the earnings of 2008 and 9 because it was a deep recession. Well, pardon me, the Shiller PE ratio, the cyclically adjusted PE ratio, takes that 10-year average for a reason. It's to include recessionary lows and cyclical peaks so that you smooth out ups and downs. Now, they will say, yeah, but that was an unusually deep recession. True, but there's only one in the 10-year history. Most 10-year spans include a couple of recessions. And this 10-year span includes includes 7 or 8 years with the highest profit margins as a share of GDP in the history of the U.S. economy. So you've got extremes in both directions. You won't find critics saying, oh, we should pay no attention to the Shiller PE ratio because recent earnings are too high.
Let's talk about some of the other objections. Another one that they frequently cite is, margins and earnings are just structurally higher these days than they were in the past for various reasons, maybe technology, maybe the internationalization of U.S. companies. Should that therefore mean that stocks are less expensive?
As with all of these arguments, there's an Achilles heel to each and every one of these arguments. The Achilles heel on the structurally higher profits is fine. The profits may be structurally higher, but if those structurally higher profits persist into the future, then the Shiller PE ratio will come down modestly in the next few years. It's still high. Instead of being 32, it might be 28 or 29. I'm sorry, 28 or 29 is still high, and that would point to 2 or 3% real returns instead of 0 to 2% real returns. Still very low real returns, just a little better than bonds. Not the kinds of real returns people want to expect on the stock market.
Well, and that leads into another common point that people make. They're like, look at how low interest rates are these days. Bonds are super low. So naturally, valuations are going to be much lower. We're not overpaying. What is the problem with that?
I love that argument. And there's a very simple retort to that. People invest all over the world with blinders on. They pay very little attention to the global spectrum of opportunity that they have at their disposal. So U.S. investors concentrate overwhelmingly on U.S. stocks and bonds. If low interest rates mean that a Shiller PE ratio of 32 is perfectly okay, then why in Europe do zero interest rates justify a Shiller PE ratio of only 16, half the multiple of the U.S.? Shouldn't it justify a much higher multiple than the U.S.? So my response to those critics of the Shiller PE ratio is to say, well, fine, embrace your argument. If you like your argument, sell the U.S. and buy Europe.